Welcome to The Long and the Short, a show where you can expect an honest take on trading, something you won't hear elsewhere. I'm your host, Sandeep Rao. You see, a little more than a decade back, when I was trying to learn systematic ways of selling options, I went through a couple of popular books, Option Volatility and Pricing by Sheldon Natenberg and Options as a Strategic Investment by Lawrence Macmillan. Now, neither of them gave a clear set of rules, but both of them pointed to the same underlying idea, that theta decay behaves differently depending on how far out you are from expiry. But what they didn't do is to specify a sweet spot where option writing could make sense in terms of time. Then sometime around 2014, I came across a version of this on Tom Sosnoff's Tasty Trade, now called Tasty Live. They had run a backtest, and the idea was to sell a strangle or a straddle somewhere around 45 days to expiry, or 45 DTE as they called it. The exit rule covering the position at around 21 DTE is something they brought in a few years later. Put together, that became a clean number that they kept pointing to across. From then on, it caught on with the options community a lot more in the US than here, because in India there was barely an audience for this at that time. And the Tasty folks still continue to recommend this approach till today. So I thought, why not test it out in our markets on NIFTY, where we now have a good 7+ years of data to work with. And that's exactly what I did. If you ever wondered how the Tasty Trade's 45 DT strategy actually holds up in India, this is it. So without further ado, let's get started. Before I start, here's the disclaimer. The examples and ideas shared in this episode are strictly for educational and illustrative purposes only. Nothing discussed here should be construed as a recommendation, investment advice, or a solicitation to trade. Trading in stocks and derivatives involves significant risk and can result in complete loss of capital. The examples and data presented are meant to explain market behavior, not to suggest that similar outcomes will occur in the future. Also, this video expects that you understand the basics for options and option strategies. So back to the backtest. So here's exactly what I did. The strategy is all about NIFTY monthly expiry. I am not touching weeklies here. I enter 45 calendar days before the monthly expiry at 3:15 p.m. by selling at the money call and at the money put together, one lot each. That's the straddle. That is, both strikes are right at the current index level, so I'm collecting the full fat premium of the at the money options and betting that theta decay does more work than the market's movement over the next few weeks. I also tested two strangles, which are 30 and 16 delta. The rest of the rules remain the same. Once we sell the straddle or the strangle at 45 DT, from there the position runs until one of the three things happen, whichever comes first. If the combined premium falls to 50% of what I had sold it for, I close that for profit as a target. If it instead doubles to 200% of the credit, I close for a loss. That's the stop. And if neither of those is hit, I exit anyways at 21 calendar days before expiry, a time stop of sorts. So I'm never sitting in the position through the final weeks of expiry. Also, the 50% target is very hard for an at-the-money straddle to reach, so this in a way becomes a hold for 21 days trade unless you get stopped out. One detail on how the exits are actually checked by the code, because it matters a lot for any backtest. I'm not doing a minute-by-minute price check. The target and the stop loss levels are evaluated only at 7 time windows through the trading day on the hourly close, using the last traded price at or before each check. So it's quite possible that the level gets breached intraday, but it's acted on only at the next hourly check, which I think is closer to how someone would realistically manage this. All the P&L show here is net after brokerage, STT and statutory charges. And all the numbers are in absolute points, not in rupees. So with the background settled, let's now start by looking at the performance of the 45 DTE straddle, or what we should be calling it, the 45 DTE short straddle. Now this is a baseline test where I have not added any filters. As you can see, the test period is from Jan 2019 all the way to June 2026. The best trade was the March 2020 cycle, entered right into the COVID crash, and the worst was very recent, the Feb 2026 cycle. And it's the same trade which caused the entire max drawdown, meaning the deepest drawdown came in the recent bad cycle rather than through some long losing streak. And it happened after the equity curve made a peak in Jan 2026, and all of that was given back in the following month. You will see this clearly when I show you the equity curves. Also do note we have omitted 6 trades across 5 years as the data for those trades was not clean. Now here's how the strategy performed year-wise. Other than 2019 and 2023, rest of the years were positive, so 5 out of 7 full years are positive. Year-wise win rate ranges from 90% in 2025 to 55% in 2020. Now let's look at the baseline strangles. We have 2 variants in it. One is 30 delta strangle and the other one is a 16 delta strangle. Let's start with the 30 delta strangle. Well, you may expect the win rate to be greater with a strangle, but as you can see, that's not really the case over here. The average premium sold obviously comes down almost 50%, and the number of stop losses hit is also almost 3 times greater, so 4 times in straddle and 12 times in 30 delta strangle. You also get more instances of target hits, which is obvious. Talking about the 20 DT exit, the straddle seems to get it right more often than a strangle. That's a clean comparison, and the average points PNL per trade is almost double for the straddle. So that's where it is. Max drawdown is more or less the same across both. Now let's look at the 16 delta strangle, and here the win rate actually comes down even further. So one way to look at that is at 16 delta the premiums don't really justify the volatility in the market. And obviously you have way more target hits, which is again understandable, but you also have the highest number of stop losses. Now, is that something which you would want? I leave it to you. Here's what I am thinking about. If you look at the total points compared to all others, it's absolutely not worth it. If I look at it, average PNL of 7.3 points doesn't make sense at all, and your drawdown is pretty much the same. We now have the equity curve and the drawdown chart for each of these 3 baseline versions which we looked at, the straddle and the 2 variants of strangles. As you can see in this, straddle is right at the top, and then we have the 30 delta strangle in yellow and then 16 delta strangle in green. The individual performances are quite evident, and that big drawdown that you see which happened recently, the one that I was referring to earlier. If you are wondering why the straddle is performing better than the strangles, the reason is basically a function of how much premium you're collecting right at the beginning of 45 DT. The more premium you collect, the greater the room for any kind of delta move in the underlying. Now moving on, one of the most commonly understood idea is that when VIX or IVs are high, it's better to sell options at that point in time because premiums are meaty. So to do that, we calculated what is known as VIX percentile. Because you cannot take the raw VIX value as a reference point. VIX at 15 is high in a calm year and low in a volatile year. So instead of using the levels, we rank it. We check where does today's VIX sit against the last 255-day trading days, about 1 year of its own history. That rank is the percentile. VIX above the 75th percentile means today is more elevated than 75% of past years' values, high relative to this market's own recent normal, whatever the absolute number happens to be. The backtest uses the rank at the moment of entry only at 3:15 p.m. measured against the prior 252 sessions. Once the trade is in, the VIX ranking has no role to play. And the thing to remember when reading the tables are that the buckets are nested. Above 75 is a subset of above 50, which is a subset of about 25. So the bucket filter trades on fewer cycles, and the greater than 75 column therefore has just around 20 trades. So now that we have a sense of what was the filter criteria, let's now see how the strategy performs once we apply these filters. What you now see on the screen is 4 areas. One has no filter, which we had seen earlier. Then we have VIX percentile filter, where we have 25, 50 and 75. The higher the VIX percentile, the lesser the number of trades, which is obvious and evident. One of the first things that you would notice is that the win rates have gone up considerably. With each level of VIX percentile, you see greater win rate, which matches the theory. While the total P&L reduces as we go because the opportunities also reduce, until about 50th percentile the max drawdown doesn't really change if you look at it. If you want much lower drawdown, then you have to go to the greater than 75th percentile in terms of VIX rank. But at the same time, the average P&L does increase. Because we sell higher premium with higher win rates, we make more points on an average. Also notice that at greater than 75th percentile, there are no stop loss hits at all. One target, and most of them end up at the 21 DTE exit level. But the number of trade opportunities are 1/4 though. Now look at this trades per year table by the VIX filter. As you can see, if we choose greater than 75%, there will be years where you don't get a single trade, and there'll also be years where you could get at max around 6 trades a year. Otherwise, you get 2 to 3 trades a year. The only downside that I see with lesser number of trades is that in an event where things don't work out, it would take much longer for you to recover from the drawdown. Now let's look at the 45 DTE strangles with the VIX filter. The impact on win rates is significantly higher with strangles with 75 percentile trades giving close to 85% win rate on both 16 and 30 delta. Also, the number of stop loss hits reduce linearly, if there is a word like that. Okay, so now we've seen the data, we've seen the numbers, and everything looks amazing, isn't it? A 70% win rate, steady points over 7.5 years, and what else could you ask for? So, shall we retire and move to Goa? Before that, a few things. One thing the numbers don't tell you is something called the gap risk. The worst trade in the whole sample lost over 1,000 points in a single trade, and it did despite of a stop because the market gapped straight through it. One trade like that is still manageable. But what if it happens 2 or 3 times back to back? While it didn't happen in the backtest period, but that doesn't mean it can't happen in the future. That's the risk we are really carrying when we sell a straddle. Having said that, high volatility periods is when this strategy really thrives. The results improve steadily as the VIX percentile rises, and at the highest bucket, that is entries only above 75th percentile, is the best of the lot. The win rate goes from 70% with no filter to nearly 86%, stops almost disappear, and the drawdown reduces sharply. So one key message is sell premium when premiums are relatively meaty. But I won't pretend it's a clean strategy though. A pro trader looking at this backtest closely will find plenty of issues and red flags. I'm only checking my stop loss at hourly close, so not continuously. So a fast price move or a spike can actually run well past our levels before we even act. Also, we are not adjusting the strikes at all, just holding the position as it was put. So in a way, what I shared here is a very simple, minimalist strategy. More like a baseline backtest, and it just gives you a decent sense of how things work. There could be many other filters and adjustments that you may want to apply to make this strategy better. So don't think of this to be a final, fully refined trading strategy. That said, among the variations we saw in the backtest, there are 2 that stand out: straddles and 30 delta strangles. Within them, I leave it to you as to which filters you would want to apply, VIX or something more. But more than the strategy and its rules, what's more important is position sizing. You have to take far less leverage than the margin lets you do. One lot of NIFTY is at around 16 lakh of notional exposure as of today. The broker will block just about 3 lakh of margin to sell a straddle. But that 3 lakh is not the risk. 16 lakhs is the risk. So better size against the notional, not on the margin. Keep the leverage to about 1.5x at most, which means roughly 11 lakhs of capital for a single lot. Even though only 3 lakh gets blocked, if you don't have that 11 lakh worth of margin, don't take the trade. That's the buffer that you need to survive a gap against you instead of being wiped out by it. On that cautionary note, I end this episode on tasty style 45 DTE straddles and strangles. I hope you found this episode useful. While it may not help you reach your FIRE goals and retire rich, but it should pique your interest if you are considering positional option selling. As always, if you have any questions, feel free to drop them in the comments. I'll be happy to respond. Till then, take care and trade safe. I'll be back soon with the next one.